One of the most critical personal finance decisions that you make in your life is how much money to spend on a car and whether you should buy, lease, or finance a new vehicle. If you're new here, hello, my name is Alice. I'm a chartered professional accountant. I graduated from the University of British Columbia. I worked in audit and tax for the first few years of my career, and then I moved into management consulting, and I was a director of a management consulting firm by the time I was 28 years old. This video is the start of a brand new series on my channel related to personal finance. So don't forget to hit the thumbs up button and please consider subscribing to the channel. Now, if you clicked on this video today, it's because you are in the decision-making process of leasing or financing a car, and you do want to make a prudent financial decision while still being able to enjoy a high quality of life and drive a nice car that makes you feel good and that you like being in. Next time you're at the car dealership, try to remember these general 4 principles. The L in left stands for liability. Now, by definition, a car is a depreciating asset. The reason it's considered an asset is because it can be converted into cash at any time. But when it comes to personal finance, textbook decisions don't always translate to reality. From a personal finance perspective, I prefer to see assets as things that will either appreciate in value or generate an income. Now, just because your car can be converted into cash does not mean that it's generating you an income or appreciating in value. For 95% of people, a car is a liability. Any version of any car that you buy, it will be a liability. If you've ever read Rich Dad, Poor Dad by Robert Kiyosaki, this is exactly what I'm talking about. I may make more videos on unique situations in the future, but this video is for people who earn employment income and they're using after-tax employment income to purchase, finance, or lease a vehicle. So the most prudent financial decision that you can make around car ownership is to stress test the idea of whether you really need a car and how long can you delay the need for a new car. Because if you can't afford to pay the car upfront, then you are incurring a financial liability. The E in left stands for earning, and that is how do you earn your money. If you are self-employed or you have a business and you use the car in your business to help you earn an income, then your decision to lease or finance will depend on the cost of the car. In Canada, if a self-employed person or a business finances a car, they will be eligible for tax write-offs. This is called capital cost allowance, and this is limited to $36,000. If a business or a self-employed person were to lease a car, then the deduction maximum is $900 a month. This means that it's generally more preferential to lease a car under a business if the car costs more than $36,000. If you are an employee using after-tax employment income to purchase or finance a car, the most important factor to consider is cash flow. And that's what the F stands for in left. It stands for flow. So what's the threshold for cash flow? How much should you really spend monthly on a car? I believe that a car should never cost more than 20% of your after-tax household cash flow. Some easy math, if you're making $5,000 after tax, you should be spending no more than $1,000 on a car payment. If you're making $10,000 after tax, you should not be spending more than $2,000 on a car. Again, 20% is a generous amount, not a prudent amount. If you want to be prudent, try to keep it closer to 10% and ideally as low as possible because a car is a liability. Now, if you have 2 cars, you're going to have to divvy up the budget. It is not 20% per car, it's 20% on cars in general. Now, the monthly payment on a finance always costs more than a lease, and I am going to dig into some calculations in just a minute to walk you through my thought process. The T in left stands for time. Are you going to be driving this car in the short term or for the long term? This is buyer behavior, and this does determine what the right decision for you is. When it comes to car ownership, a lot of people make the mistake of overanalyzing the factors that don't really matter that much. Things like residual value, interest rates, opportunity cost of money, they're all fairly negligible and what I would call secondary factors to your decision-making process. What actually has an impact on your financial situation is cash flow and how long you keep the car for. And I will prove this to you with my calculations. So here is my lease versus finance versus purchase upfront model. In this first example, I'm going to walk you through the calculations and then I will show you some different scenarios of how this would play out if we change some of the numbers. So for this first example, we are going to use an economy car. So I'm going to pick the Toyota Camry 2024 and I went to their website to take a look at what the current price is and what the charge is for a lease or a finance payment. Cost of the car is $33,972.50. And let's just do an analysis over 4 years. The interest rate on both the finance and the lease option are both 5.99%. The residual value only applies to the lease, and this is basically the buyout value of the car at the end of the lease term. So if you were to lease the car, you would have the option to buy the car at 15,185.1. And you can see here that the monthly payments have already calculated themselves because I put in a formula to account for this. If we cross-check this against the website, what they're saying is the payment will be $514.37. So that's actually correct. I actually added tax onto this. And likewise for the monthly payment. Now my model does take into account the time value of money. The time value of money is a finance concept. It just means like $1 today is worth more now than $1 in 5 years. What this means is we just have to take the present value of all the cash flows when we are looking at an analysis over 4 years. Now, the fair market value of the car is going to be an estimate of what we can get for the car after 4 years. Cost of a 2020 car it's about $26,000. So that's the number we're going to use. And you can see here that this means that the car will depreciate by approximately 22%, which is the difference between the price of the car today and the price of the car in 4 years. We're going to take a look at the cash flow over 4 years. So if you were to purchase the car today, it would cost you the price of the car plus tax. In this example, it would be $38,000. And if you were to lease the car, it would basically be the lease payments, which is $576.09 times 12, which is $6,913.10. So that would be the lease payments, and you would pay the same amount over 4 years. And then for the finance, it's the same thing. It would be the monthly payment of $893.41 multiplied by 12. So I just put those here. And then I just did a present value calculation to account for the fact that, money today is worth more than money in 4 years. This is where it gets interesting because in year 4, in order to make this analysis fair across purchasing upfront, leasing, or financing, we're going to assume in all 3 scenarios that you would sell the car at market value. So let's say we sold the car at $26,500 in all 3 scenarios. Well, if you purchase the car upfront or you finance the car, then you can just sell the car, right, at market. So you would literally go onto a website like Car Gurus, list the car, maybe go on Craigslist, private sale, whatever it is. This is just what you can get in a fair market. So for the lease section, in order to make this a fair analysis, we have to account for the fact that you would be buying the car out first from the dealership. And how much does this cost? So it costs $15,185, which is what the dealership quoted us here, plus tax. So plus 12% tax. So 15,185.10 plus 12% tax is 17,000. So you would buy the car out from the dealership, sell it at market value, and this is the net cash flow that you would get. Now, the last step of this analysis is just to add up the difference between all of the outflows as well as the inflows, right? So that's these 2 cells right here. And in the buy up front option, that would give you net cash flows about $17,982.93. Buy the car out after 4 years, then sell the car. That would be $17,801.15. That's these 2 numbers added up. And if you were to finance the car, you would be looking at these 2 numbers here. And the net of these 2 numbers is minus 18,000. So what conclusion can we draw from this analysis? So you can see here that the difference between purchasing, leasing, and financing is actually not that significant, right? It's not a huge difference between these 3 options. I mean, technically, you save the most leasing by about $100. It's a little bit more expensive to finance in this case, but the general conclusion that we can draw is that there isn't really a significant difference between purchasing up front, leasing, or buying at the 48-month mark. So after 4 years, assuming that you're to sell the car in all 3 scenarios, there isn't a big difference. Another point that I want to make is that in an economy with good interest rates, the overall cost of ownership will be lower across all 3 options. So what do I mean? Let's just say we were in a better economy and the cost of borrowing from the bank is like 3%. And, the interest rate, just plugging some numbers in here. So you can see here that the absolute cost of buying upfront, leasing, or financing is much less because all of the interest rates are lower. But even then, if all the interest rates are lower, the comparison across buying upfront, leasing, or financing is still the same. It's definitely not a significant enough difference between the three for you to really lean towards one or the other. So in this second example, let's look at the long-term analysis of the same car. So all other things equal, but we're going to assume that we're going to keep the car in a purchase upfront or finance situation until year 8. And the fair market value at year 8 of this car is $16,000. Based on this number, the value of the car has depreciated about 52% since the date of purchase. And again, you have the 3 different scenarios of whether you would buy the car upfront, lease, and finance. And in this option right here, I'm going to also add in maintenance costs because that's important too. So let's just say the maintenance costs are $500 a year and they're going to go up by 10% every year. So if you bought the car upfront in cash today, let's assume that in 8 years, you're going to do the same thing. So let's just say that it goes up to $42,000. Maintenance costs on the second car, taking inflation into consideration, is $800 a year. Now for the lease option, I'm going to assume that during this whole period, you have been leasing a new car every 4 years. And for the finance option, we are going to assume that you sell the car in year 8 and then you finance another car. So you're financing the car that costs $42,000. And the reason why the maintenance costs don't start until the 5th year is because, if you purchase a new car, presumably under the new car warranty, you wouldn't have to pay out of pocket for maintenance. Maintenance costs don't start until the 5th year of car ownership. You can see here that the cost of leasing is the highest of the 3 costs. And if you purchase upfront, you do save the most in the long term, but the cost of leasing is quite significant compared to the other 2 options. So what can we conclude from this second example where we're looking at the same car as in the first example, but over a longer term horizon? We can conclude that leasing saves you cash in the short term, but it puts you off in the worst financial position in the long term. And this is really important to point out because you can see here that the cash flow difference between these 3 options is quite significant. That's why I was saying earlier that cash flow is a huge determining factor in your decision to purchase a car because that will directly impact your lifestyle. With leasing, you do save upfront every year, but in the longer term, and we're talking a long-term horizon, you do end up in the worst off financial situation. Another thing just to consider is quality of life, right? With leasing, one of the benefits is that you get a new car every 4 years, whereas in the purchase or the finance, you're driving 2 cars over 16 years. So quality of life is definitely highest when you get to have a new shiny toy every 4 months, but it does put you off in the worst financial situation between the 3 options. Now you might be wondering, does this analysis change if you purchase a luxury vehicle or a car that costs more expensive? So I did take a look at a Mercedes GLC 2024, and these are the numbers that I found on the website. The price of the car is $69,000. It's the same example as with the Toyota. We're going to look at it over a 4-year period. These are the payment amounts whether you buy or whether you lease, and these are the current interest rates that I took from the Mercedes website. And of course, if you buy, there is not a residual value, and if you lease, this is the residual value that they are showing. The fair market value of a 4-year-old Mercedes GLC is around $45,000. So this means the car does depreciate at about 35% after 4 years. Similarly to the first example, we are going to do a comparison where we sell the car in year 4. And for the lease, we are going to assume that you would buy the car out at the residual value from the dealership and sell it at the fair market value. Now, it is possible that you would get a little bit more than $45,000. So what if we changed this to $55,000? You can see here that the fair market value doesn't actually really change the purchase, lease, or finance in terms of the decision that you would make between the 3 because they're all still really close to one another. So it's not the fair market value that's really impacting the decision. Relative to one another, purchase, lease, or finance, they would all be pretty similar. And that's because there is not a significant or a material difference that would impact your quality of life between these 3 options if you were to lease, buy, or finance at the end of 48 months. Again, where the cost of ownership really does start to matter is when we start to look at things over a longer term horizon. So using the same numbers as previously, what if we were to assume that we would just lease a new car, the same car, every 4 years? This is a luxury car. The maintenance cost is usually a little bit more than it would be on a Camry. Now, this is really interesting because even after the second lease term, it's a little bit cheaper to lease. You are still saving on the big difference between the lease and the finance payments. It's not really until the third lease term that the leasing starts to really cost more. So from a cash flow perspective, leasing does save you cash in the short term because this is a huge difference, right? And a lot of luxury dealerships do prefer that you lease because that's how they make their money, but it does put you off in the worst financial situation in the longer term. And really important, the cost of living between these three options is huge because this requires $80,000 upfront. This requires $20,000 a year, and this is $12,000 a year. So this is a big difference. At the 4-year mark, it is slightly more advantageous to lease than to finance, which makes sense because this is a luxury vehicle and most luxury dealerships do prefer that you lease because they want you to keep leasing in the longer term. As you can see here, assuming that you continue to lease from the same brand or dealership, this is where they would make a lot of their money. And even in an 8-year time horizon, you do save the most on the lease. It's not until you look on a longer term horizon that leasing does become the most expensive option. So there are a few factors here to consider. There's quality of life, which means that under a lease option, you do get to drive a new car every 4 years, but financially it is the least prudent decision. Going back to the L.E.F.T model, the cash flows between these three options are significant and will impact the quality of your life and the timing of your decision, and looking at things in a longer term perspective rather than in a short term perspective. Because whether you buy a economy car or a more luxury car in the short term, it's not a material difference between the three options. If you like this video today, please give me a thumbs up. I am planning to make some more personal finance videos in the future. Please let me know down in the comments below what your thoughts and opinions and experiences are when it comes to car ownership, and I'll see you guys in the next video. Until next time.